Our attention to the bond market, opening mixed this morning. Investors, of course, re-evaluating now the gross domestic product numbers and shift to safe haven buying. Let's get more on that equation with Stephen Nash from FIG Securities. A warm welcome to you. Just explain how the bond market sort of took those numbers in yesterday, the surprisingly robust GDP figure.
Well, the market was a little bit surprised at the strength of GDP. People were looking for something around flat or possibly slightly negative. So a positive number was a little bit of an upset. But over the last few weeks, the market's been a little bit concerned about the possible strength of the recovery. There have been announcements that, if required, the central banks will take away the current stimulation in the economy. So the market's getting a bit concerned about the prospect of a withdrawal of stimulus.
And that has what, a knock-on effect with corporate yields in particular, if that guarantee is taken away?
Well, in terms of, we're talking about the monetary policy, the level of monetary policy and whether that goes up or down, and the market's thinking about the possibility of rates going back up. What's been happening because of that optimism in terms of the economy, people have been, it's been reflected in higher equity prices, and corporate spreads have come in substantially. So for corporates, I suppose it's good news in the sense that it implies the economy is going to do a lot better than previously expected. So levels of issuance are a lot lower than they have been for a long time. What
about the government yield, if we bring that up as well, the benchmark? What is that pointing to, if you talk to those numbers for me, particularly on the 5-year?
Well, the government yields implying that, the rise in yields are implying that the market's expecting the current recession to end fairly soon, and that possibly a tightening might be evident.
Is that issuance, what's the uptake like on from what you're hearing on those issuances at the moment?
The government?
Government,
Australian government issuance is proceeding quite effectively. There's no problem with tenders or anything at this stage. We don't foresee any problem with the Australian government issuance whatsoever. There could be difficulties going forward with regard to large issuance in the UK and the US. We have seen already some difficulties in the UK tender system, but the volume of issuance in Australia is quite small relative to those other countries. If anything, we really need these extra bonds because the market's been too small for too long. Yeah.
Indeed, and one sort of isolated retail offering doesn't even imply that the door's open for a broader uptake either. The likes of the Tabcorp offering, seen as a bit of a blip, some would say. We need to see further signs of corporates using that mechanism.
We anticipate that, given the steepness of the curve, that retail investors are concerned about equities, and that they want something that's higher yielding than cash, and they want something that's fairly secure. So we think the retail market is set to go quite well. We expect extra issues. We think that that Tabcorp mightn't have been able to get that issue away in the wholesale market, but in the retail market they were able to get a large volume away, and we expect other corporates to take advantage of that.
What made that secure, though, out of interest, Stephen, when, if anything, we hear about licences potentially being revoked? Well, not potentially, but that has been the thematic in various states for the company. Earnings and all the rest of it can change it sort of at the stroke of a pen, can't they, for a lot of these companies?
Yeah, well, we're talking about typically investment-grade companies that are reasonably solid. I mean, there's no guarantees with these particular corporates. Tabcorp...
Whereas there is a guarantee with the government.
Yes. Recently, I mean, what's been happening is we've begun the government yields going up and corporate yields going down.
Which that gives the lie to that whole equation. How do you understand that?
Well, at the moment, it makes governments a little bit more attractive relative to corporates. If you look at the iTraxx, it's come in substantially in the last 3 months. It's come in,
Well, let's look at that. Let's bring that one up. And
yeah.
Okay.
From the March high there, it's come in substantially. One would imagine that there's time for a bit of a pause here. I mean, the re-evaluation of spreads is quite dramatic. So we imagine that the market will pause and consolidate possibly at these lower levels. Really all depends on the trajectory of what people think the economy is going to do going forward. And you've seen that the equity market's priced in quite an optimistic situation right now.
Can you explain also this phenomenon of a state like New South Wales, which is tapping the bond market, as I understand it? It might undertake an offering, and then what would happen if its credit rating was then subject to a downgrade post-offer? what happens to the security of those bonds for investors?
Well, really, it's really not that big a deal for investors in the sense that the market's pricing that in at this stage. So if there was a potential downgrade, I don't think the prices would move that much. Yields wouldn't change that much. In the case of TCorp, we expect that they'll be continuing to maintain that AAA rating. There's a lot of issuance that has to be done in their case, and we imagine that they'll do everything they can to keep that rating.
So the likelihood of a downgrade has been priced in with the price that's being offered?
Yes, at this stage, yes.
Right.
So, it wouldn't be that dramatic for investors, no.
Mm-hmm. Just a final thought as well on the blowout in government yields. I mean, at what point do we need to start being concerned that that is going to really encumber the government's ability to repay its debt longer term?
Look, there's a positive and a negative here. The positive is that the market's implying a recovery in the economy. Now that's good news for the government in the sense that revenues will increase and that the funding task will be less, yeah? Obviously the negative is that rates are higher and that the payment will be, as a result, yeah, well, the payment of debt might be higher than previously anticipated. The coupon payment might be a little bit higher, but I think the positive is more important here. I think, if the market's pricing in a recovery, that's very good news for the economy, and the funding task will shrink as receipts increase. Yeah?
What happens though when we do get a negative GDP print? What does the market then imply about a recovery?
Well, it really depends about expectations and whether that is built into the market. For example, if the market was expecting a quite positive number and we got a very negative GDP read, that could get the market thinking again of recession, and you'll see that reflected in stocks and corporate yields going out and government bond yields coming down.
And just a final thought on that, because we are, in theory, one of the last developed countries to go down that route of recession, does that make the funding task ever more hard because markets treat that as a play, as a longer-term sort of wallowing before we get ourselves out because we're last out of that equation?
In the case of Australia, we have very conservative levels of debt. We've been very careful about the levels of debt over a long period of time. The issuance task isn't really that large. I can't really see any major problem in the sense, in the Australian case in particular, no.
Stephen Nash, on that surprisingly bullish note, many thanks.
Thank you.
See you next time from FIG Security.